Archegos, the 100 billion collapse nobody saw coming. On the morning of March 26, 2021, the phones started ringing on Wall Street. Not the polite calls, not the scheduled meetings, the emergency calls. Morgan Stanley was calling Goldman Sachs. Goldman Sachs was calling Deutsche Bank. Deutsche Bank was calling Nomura. Every major investment bank on Earth was suddenly, simultaneously, trying to understand the same terrifying thing. A company nobody had ever heard of had just vaporized $100 billion in 2 days. And the man responsible had done it all legally, invisibly, using a financial instrument so obscure that most of the banks holding his positions didn't even know the others existed. His name was Bill Hwang, and what he built and destroyed in the space of 48 hours is one of the most extraordinary financial implosions in modern history. Bill Hwang was born in South Korea in 1964, the son of a pastor. He came to the United States as a teenager, worked his way through UCLA, and eventually landed a job at one of Wall Street's most legendary hedge funds, Tiger Management, run by the celebrated investor Julian Robertson. Robertson ran Tiger like a university. He recruited brilliant young analysts, trained them in his methods, and then released them into the world as what the industry came to call Tiger Cubs. Former Tiger employees who went on to run their own successful funds, carrying Robertson's investment philosophy with them like intellectual DNA. Bill Hwang was one of them. In 2001, he founded his own fund, Tiger Asia Management, and for a decade he was extraordinarily successful. At its peak, Tiger Asia managed approximately $8 billion, making Hwang one of the most respected Asian markets investors in the world. Then, in 2012, it all fell apart. The United States Department of Justice charged Tiger Asia with insider trading. Hwang pleaded guilty. The fund paid $60 million in fines and was shut down. Hwang was banned from managing outside money, meaning money that belonged to other people, by regulators in Hong Kong. Most careers end there. Bill Hwang's was just beginning. Because there is a structure in the American financial system that allows someone like Bill Hwang to keep operating, quietly, invisibly, beyond the reach of most of the regulations that govern ordinary investment funds. It is called a family office. A family office is not a hedge fund. It does not manage money for outside investors. It manages only the personal wealth of one individual or family. And because it has no outside clients, it is largely exempt from the registration and disclosure requirements that apply to conventional investment managers. Hwang took the money he had accumulated. Estimates suggest somewhere between $500 million and $1 billion of his own capital, and poured it into a new entity called Archegos Capital Management. Archegos, a Greek word meaning one who leads the way. And then, with that relatively modest pool of personal capital, Bill Hwang proceeded to build one of the largest single-stock positions in Wall Street history. Not by buying shares directly, by using something called total return swaps. A total return swap is a derivative instrument, a financial contract between two parties where one side agrees to pay the other the total return of an underlying asset in exchange for a fee. In simple terms, instead of buying a stock, you make a private agreement with a bank. The bank buys the stock. You pay the bank a fee and a margin deposit. In return, the bank pays you all the gains if the stock goes up, and you absorb all the losses if it goes down. The critical feature of this arrangement, from Hwang's perspective, was invisibility. When you buy shares directly in a public company, regulations require you to disclose that position once it crosses 5% of the company's outstanding stock. That disclosure is public. The market can see it. Other investors can react to it. Total return swaps don't work that way. Because Archegos didn't technically own the shares, the banks did. There was no disclosure requirement. Nobody outside the individual banks knew the full scale of what Hwang was doing. And because he was working with multiple banks simultaneously, each bank only saw its own piece of the picture. None of them saw the whole. Using this structure, Hwang borrowed aggressively. At the peak of his operation, for every dollar of his own capital, he controlled approximately $5 to $8 of stock positions. His portfolio, built on borrowed money, hidden from public view, spread across multiple banks who each thought they were his primary partner, swelled to somewhere between $100 and $115 billion. One man, one family office, $100 billion. And almost nobody knew. The stocks Hwang concentrated on were not obscure. Viacom CBS, Discovery, Baidu, GSX Techedu, a handful of large publicly traded companies in media and Chinese technology. What was extraordinary was the scale of his positions. In Viacom CBS alone, Hwang had accumulated a position that represented approximately 30% of the entire company's outstanding shares, held indirectly through swap agreements with multiple banks, invisible to the market. For months, the strategy worked. Hwang's positions were so large that his buying was itself driving up the prices of the stocks he owned. As the stocks rose, his portfolio grew. As his portfolio grew, he borrowed more. As he borrowed more, he bought more. The machine fed itself, and then Viacom CBS made a decision that broke it. In late March 2021, Viacom CBS announced a secondary stock offering, a sale of new shares to raise capital. This is standard corporate practice. Companies do it regularly. But when a company issues new shares, it dilutes the value of existing shares. More shares outstanding means each share is worth slightly less. Investors who hold large positions often sell ahead of this dilution to protect their returns. The stock began to fall. For Bill Hwang, a falling stock price was not just a paper loss. It was a margin call. When you use borrowed money to buy stocks through total return swaps, you're required to maintain a certain level of collateral relative to your positions. When positions fall below a threshold, the bank calls you and demands additional collateral, or forces you to sell. Hwang's positions began falling. The margin calls began arriving. And here is where the invisible structure he had built became catastrophically visible. Because Hwang had borrowed from multiple banks simultaneously, each bank now discovered in rapid sequence that every other bank was also holding enormous Archegos positions. The total exposure to one single unregistered family office was staggering. Credit Suisse alone had lent Archegos approximately $20 billion. Nomura had lent approximately $2 billion. Morgan Stanley, Goldman Sachs, Deutsche Bank, UBS, all had significant exposure, and all of them needed to sell at the same time. What happened next is known on Wall Street as a fire sale. When multiple large institutions attempt to liquidate the same position simultaneously, the selling pressure is catastrophic. Prices don't just fall, they collapse. And as prices collapse, each bank's position deteriorates further, triggering more selling, which drives prices lower still. Viacom CBS lost 50% of its value in 2 weeks. Discovery fell 40%. Baidu and other Chinese tech stocks collapsed. For the banks, the question became a brutal calculus of speed. The first institutions to sell would recover more of their money. The last would absorb the worst losses. Morgan Stanley and Goldman Sachs moved quickly. They organized what is known as a block trade, a large coordinated sale of shares to institutional buyers, executed after market close to minimize panic. They sold billions of dollars of Archegos positions and largely protected themselves. Credit Suisse moved slowly. Whether due to internal miscommunication, risk management failures, or simple bureaucratic delay, Credit Suisse did not liquidate its Archegos positions with the same speed as its competitors. It lost $4.7 billion in a single quarter. For Credit Suisse, the Archegos collapse was not just a loss. It was one of a series of catastrophic risk management failures that would, over the following 2 years, erode what remained of the bank's credibility and eventually contribute to its complete collapse in March 2023. The end of a 167-year-old institution. Nomura lost $2 billion. In total, The banks that had funded Archegos lost approximately $10 billion between them. Bill Hwang was arrested on April 27, 2022, and charged with racketeering conspiracy, securities fraud, and wire fraud. Federal prosecutors alleged that Hwang and his associates had deliberately manipulated the prices of stocks in his portfolio by coordinating purchases across multiple banks to artificially inflate valuations, building an empire on a foundation of deception that prosecutors described as one of the largest cases of market manipulation in history. In July 2024, after a lengthy trial, Bill Hwang was found guilty on 11 of 11 counts. He was sentenced to 18 years in federal prison. His former chief financial officer, Patrick Halligan, was also convicted. The $100 billion empire was gone. The family office was dissolved. The stocks had recovered over time to various degrees, and the banks that had enabled it all, that had lent extraordinary sums to a man with a prior conviction for insider trading, that had each failed to compare notes with the others, that had collectively allowed a single unregistered entity to accumulate systemic risk invisible to any regulator, faced fines, internal reviews, and, in Credit Suisse's case, extinction. The Archegos story is not ultimately about one man's greed. Every financial scandal contains greed. Greed is the constant. It is not the variable. The variable is the system that permitted it. Bill Hwang did not invent total return swaps. He did not create the regulatory gap that exempted family offices from disclosure requirements. He did not force multiple competing banks to lend him money simultaneously without coordinating their exposure. He simply looked at the system with clear eyes and understood what it allowed. The derivative instruments that made Archegos invisible were legal. The family office structure that exempted him from registration was legal. The leverage he used was technically within the boundaries the banks had set. He was convicted not for using the system, but for lying to the banks about his positions and deliberately manipulating stock prices to sustain the illusion of his portfolio's value. But the deeper question, the one that regulators in the United States, the United Kingdom, and across Europe are still debating, is why the system had a gap large enough for $100 billion to move through it without anyone noticing. The answer is that financial systems are not designed to catch the thing they haven't seen before. They are designed to prevent the last crisis, not the next one. And somewhere, right now, in a structure that hasn't been named yet, using an instrument that hasn't been regulated yet, someone is building the next Archegos. The only question is how large it gets before the phones start ringing again. Money, power, secrets. If this story made you see the world differently, subscribe to Fincora. Every week we go behind the headlines, past the press releases, and into the invisible rooms where the decisions that shape your money are made without your knowledge. The next story is already waiting. Duration: 10-12 minutes. Pure narration. Fincora cinematic style. General audience.